With that, we have a great panel again, the pulse of opportunistic real estate. Where are we now and what does the future hold for opportunistic real estate investments? We've got an esteemed panel listed here with Bill Shopoff from Shopoff Realty, David Becker from TEI Equities, Jim Solomon from Ravinia Capital Group, and Bernardo Lozano from Participant Capital, and I will moderate. So at this point, I'm going to just turn it over so everyone can see each other, and everybody from the listening audience, again, can see the group. So what I would like to do is start off with just a minute or less of everybody just taking time to introduce themselves and kind of give a little bit of a summary of their company. And from there, let's start off with Mr. Bill Shopoff.
Thanks, Neil. Appreciate it. Great being here with you, everybody, today. I'm Bill Shopoff. I'm President and CEO of Shopoff Realty Investments. We're a 28-year-old opportunistic value-add real estate investor founded in Austin, Texas, currently headquartered in Irvine, California.
Great. Bernie?
So my name is Bernie Lozano. I'm with Royal Palm Companies and Participant Capital. We are affiliated, of course, with the parent company, the developer, owned by Daniel Kotze, who's been in the development business in Florida for close to 40 years. And we are basically a ground-up developer with extensive properties in residential and mixed-use development.
Great. David Becker.
Thanks, Neil. So I'm David Becker. I'm Managing Director at TEI Equities. I'm on the Investment Committee Advisory Board also. We have a large portfolio of office, retail, residential, industrial, student housing spread throughout the US, Canada, and Europe. And we've been around a long time, going back to the mid-60s. And I think we're fundamentally known as value-add opportunistic players.
Great. Jim Solomon?
Jim Solomon, founding principal of Ravinia Capital Group. We're a single-family office investing in 4 real estate food groups around the U.S., office, industrial, multifamily, and retail. And we're in the Southeast U.S., Texas, Midwest. We're based in Chicago, so in and around the Midwest there, and then also out west, Phoenix, Scottsdale, and stop off in Denver on occasion. We are a value-add and core plus real estate investor. We buy in the middle market, 10 to 75 million. We've been in the business for about 5 years, and I'm a 30-year real estate professional.
Right. All right. So let's kick things off. Obviously, we have a great group of people listening, and obviously an esteemed group of panelists. So the most important thing is, what's been the effect of COVID-19 on different asset classes? What have you seen? And let's kick it off with Mr. Shopoff.
Yeah, Neil, I think as everybody expected, retail certainly taking a little bit of a pause, and both from operations and then transactionally, the debt markets really seized up for retail investing, in late March, and they're barely opening up. I mean, for high quality retail, I think you can get it financed, but for most stuff right now, that book is still closed. Second for us has been office. I don't know whether it was initially probably surprising. Today it's probably not, as we're all kind of wondering. Let's see, I guess some of them are sitting in the office, but we're 50% in the office out of this group. So I think that's going to be the way it is, certainly until the end of the COVID run. And I think David mentioned it. Our office has been open the entire time because we're real estate in California's essential business, but we've been minimally open. I would say we're today 10 to 25% of our employees come in on any given day. But our resi, we're collecting 100% on our residential, and our industrial's the same. So overall, our portfolio, we collected about 92% last month. Looks like we're on track to do about the same this month. It's just been a lot more work to go collect it. I think that from a acquisition standpoint, we're just starting to see some deals, and I would say they're interesting, but they're not what we would call massive distress. So really, the only distress we bought through so far is we were able to buy our own note back on one of our shopping centers.
Yeah.
And that was the best deal we could do. It was easy underwriting, and we closed in 2 days. And bought it at 70% of face on a performing shopping center. So it felt like a pretty good buy. So.
Right. David, same thing. What effect has COVID-19 been on different asset classes?
Well, so we have a wide portfolio. We obviously what's happened is the two favorite asset classes going in pre-COVID were industrial and multifamily, and so this event really sort of drove more demand towards those two asset classes. So where you're obviously seeing weak points, as Bill indicated, is in retail. Fundamentally, retailers aren't really allowed to operate their businesses in a normal way, so that's problematic. And then I think there was the Amazon effect, where a lot of the retailers, in my opinion, were sort of zombies before this event, and this sort of kicked everyone over. So retail clearly is showing a weak point. Residential has been very, very strong. Multifamily, industrial strong. I think there's sort of a pushback from China now, where I think you're going to see a large increased demand on industrial. Student housing is sort of, an office is sort of the conundrum right now, because with office, you have the work remote dynamic. So it's really hard to tell where that's going to land. Oddly, I think it's going to end up being neutral. Companies will need more space. And then also you have a work remote dynamic. And then student housing, there's just no clarity on how that's playing out for the fall. So it's very hard to underwrite something. So, there's just shifts going on in different parts of the country, and we're seeing different things in Europe and Canada. So it's been an interesting time, and just continuing to monitor activity.
Right. Jim, what is your family office seeing on the different asset classes, the effect?
To augment what these guys are, what Bill and David said, they're absolutely, complete accurate in what I've been able to see. But just one more comment: the debt capital market, real estate transactions are driven by debt, and in transitional real estate, which is stuff that's not fully stabilized in any asset class. Notwithstanding hospitality and retail, which have been stressed, both retail before this ever occurred, and hospitality certainly with COVID. With transitional real estate, there's virtually very little debt liquidity, if at all, and the debt liquidity is very wide. In other words, the pricing of the debt you would have borrowed pre-COVID is so much greater than what it would have been without COVID. So sellers aren't willing to sell into that market to have, because buyers want to pay, they plug in the debt cost and they want to pay, 10%, 20% less, and the seller doesn't want to sell. So until there's more clarity on where we're going with this whole thing, the markets are basically arrested. And then on the more stabilized stuff, there is deals getting done, but they're just getting done at risk premiums, wider than they were prior. So we have private debt funds that are basically either out of business or lending at 200 to 300 basis points wider than they were. The banks, most investors, most companies drew down 100% on their credit lines. The banks aren't sure whether they have enough reserves or not. And then separately, the life companies are always, they're always kind of late to the game, late to the party, but they have plenty of money. And ultimately, all these different lenders have to deploy capital at some point. So we're again, nobody has any crystal ball. We'll see. And then the only other comment I can make is, we don't have a lot of industrial right now. We don't have that much residential. We have more suburban, kind of in, high growth market office buildings, and our rent collections are 96, 97%. And I do believe, the good news is with office buildings, as well as maybe, well, not residential, but, you have longer term leases. So the tenants, even though they're not in the buildings, they're still paying rent because they have to pay rent. And then you're asset neutral on whether, I agree with what David said about more space or less space. Depends on whether you're in a 1 million square foot office building in the middle of New York City, or you're in a suburb where people can come up and park and they can walk up the stairs of the building. But student housing, probably the best student housing market this fall. People are going back to school because most people do not want to be in the dorms, because the dorms are going to be so prohibitively restrictive. So we were kind of heading into an oversupply of student housing for the most part. I think, and they've been building like with abandon the last couple of years, and it was definitely necessary. But we'll see. Industrial is, out of control, both because of the onboarding from overseas, as well as, now all these companies have redeployed their supply chain, and, they're trying to basically ship you stuff versus have you walk up and buy stuff. So
right, great, awesome. So the next question here, which I think is really on top of everybody's minds, were you prepared for a pandemic like COVID-19 in your portfolio? And what do you do going forward now that you know that it's out there? So I'll start off with Bernie. I know that we haven't heard from you yet. What do you think, Bernie?
Thank you. Actually, if I could just elaborate for a second on the whole COVID, we we have been very sensitive to that, and Dan Kossi and others came up with some notes early on in the year, and there were certain patterns that we saw developing around COVID. We looked at that, and broadly speaking, in terms of the COVID impact, you might say we're tracking. I wouldn't say successfully or not. That's to be determined. But we're tracking later in the cycle from a China, South Korea, Singapore, Taiwan, Europe. So obviously, because we're tracking them, even areas that were extremely heavily hit, like Italy and elsewhere, we have a learning window, a learning opportunity of data from their experience, and we think we're understanding a little bit of the impact here it's having. Consequences of quarantines are going to be an ongoing issue. Social distancing obviously is going to continue for the better part of the year, maybe even into a habit forming Q1 and beyond. We do think there's going to be cleaning protocols, as unusual as this is. There's going to be mandated formal cleaning protocols in public spaces, public buildings. Some of the building design that we're doing right now is actually incorporating, there's been some changes to incorporate a permanence around no touch access, no touch elevators, and things of that nature, and cleaning protocols in buildings. I think that's going to be an ongoing issue. Also, we did notice we identified 4 phases of where we think we are in the pandemic. Neil, you asked about if it caught us by surprise. Obviously, to all of us by surprise, but we identified 4 stages, right? Phase 1, where we were awaiting the major impact. You might say that's the January, February timeframe. We knew it was there. We were hearing about it. No one really understood what was coming, and that was a January, February timeframe. Phase 2, we looked at withstanding the initial impact. Obviously, that's when the U.S. began to go into lockdown. February, March, April was the core period of time where we were standing that initial impact. You could say we began to return to normalcy. We tested the waters around the mid-May. We went back to our offices in mid-May. We have a small office here, so I think Bill earlier on mentioned accounting. Certain key departments rotated their staff, so they'd have no more than 30 to 50% at any one time, but there was a continuance of presence in the office. So we're in that stage of returning to normalcy with spurts and drawbacks. And then where we think we'll be, hopefully by Q1, is sorting it out and assessing the new industry dynamics, right? Some of my panelists mentioned the business to consumer, the business to business dynamics, especially in the area of office utilization, capacity, things of that nature. So we think we're going to enter that post-vaccine development, I'd say into Q1. So all in all, we're not that pessimistic about it, Neil.
Good. Bill, were you prepared?
I don't know how you prepare for this, but where we had been forecasting a recession of some type, so we had been buying more defensively, and I went back and looked at like the things we bought from late 2018 through Q1, including we bought a hotel site in February in Las Vegas, and I got to tell you, I'm happy with everything that I bought. And we're actually, of the 6 deals we bought from late 2018 through the beginning of 2020, we're going full cycle on 3 of those this year. And we're going full cycle at prices that are in line with our pro forma. The good news is we buy, as you know, Neil, we do a lot of single family for sale land. And that business took a complete pause in, what do you call it, a pause? It just died, about March 12th here when the governor put a lockdown order on us here in California, and it just shut down. I had a number of closings that were in process; they all stopped, but all of those have come back, and people, move forward and remove contingency on their contracts. And they're starting to close those deals, and they're closing them at the same pricing as they were pre-COVID, because they're getting those prices or above for the for sale product, because people are they want a little space. They've spent 3 or 4 months in their apartment or in their small house with all their family, and for a while togetherness is really cool, and then for a little, then you want a little space. I'm in my office today. I'm back and forth from my office to my house, and I have a really nice house with a nice view, but still, even at that, I want to change the scenery after a while. So I think that we had our portfolio pretty well prepared. We've been able to manage, as I said, the only thing we did was buy debt. We haven't had to ask for forbearance from anything because we've been able to service all our debt. We did cut back distributions. We've held capital because we think it's prudent until you know directionality where things are going to go and how long it's going to be. So we've pulled back on our distributions, but we're not well known for distributions anyway. That's not what we do. We're value add, and when we do that value add or opportunistic play, then we do more capital gains distributions. So people don't generally come to us and look for us for a monthly or quarterly check. So that hasn't impacted. I'm sure it's impacted a few people, but it's not been that dramatic a pullback. But we're seeing deals. One of the food groups we haven't talked about is hospitality, and we are making deals on some hospitality trades today. We've got 2 deals in final negotiations that we were actually pursuing pre-COVID. But we're not buying them for the hospitality trade. We're actually buying them with an idea to convert existing hospitality to kind of what I call blue collar multifamily. We're taking old residence inns and converting them, and so we were able to get our workforce housing, and so we're getting our basis down on those assets from where we thought we would be in February, and we don't think our revenues have changed at all. So we like that trade where you're getting a hotel that was probably a 7.5 to an 8.5 cap in February, and now that's probably an 8.5 to a 10 cap trade. And the multifamily trade is 5 cap, and the NOI doesn't really change that much from the hotel user to the apartment user, but you get this great cap rate compression. So and obviously you get financing, because that's the one area where Jim was talking about the real estate trades on the sum of the cost of your debt capital being whatever that is, 50 to 70% of your stack, and what the risk premium is that we want for our equity. And debt's gotten a lot more expensive in every food group except multifamily. Stabilized multifamily
And industrial.
And industrial. And
Yeah.
those are 2 things. We're fortunate we're pursuing some of both. We actually just got it, and we just got approval, in the short fight that it takes here in California. We just got our court award on a victory on a CEQA battle on a 1.8 million square foot logistics center, which we'll break ground on later this year. So
Congratulations on that.
embarrassed to tell you how long I fought that for, but I got the victory now.
California.
I got the W, so good time to get it. So
David, I know you're always prepared, but what about Time Equities? Were you guys prepared for a pandemic, and what are you doing to go forward?
Well, the only person I'm aware of that knew this was coming was Bill Gates, and he did say something in 2015 or
Right.
16 that we should all be prepared. But no, I mean, we obviously no one saw this coming at the magnitude that it came and that it's here. The nice thing from a Time Equities point of view is we underwrite very, very big downside protection when we do our fundamental underwriting. And we're very hyper diversified in all different parts of the country, Canada and Europe and whatnot. So I think our underwriting was sound, and of course that became very, very important because we're fundamentally built on reserves and having reserve capital. So that was helpful. But look, maybe because we were also in New York City, sort of in the heat of it, really when it first sort of took off. But New York, New Jersey, Connecticut, I mean, it was scary the tail end of March, April. I mean, we were in foxhole mode. I mean, we really, at the company level, for a company of our magnitude, we locked down, and we were really looking to make sure the house was in order. And you know, we shored up our bank credit lines. We have a lot of availability with large banks. Obviously, our chairman is very, very well capitalized, and we made sure that we were really doing the right things. We stopped all cosmetic work at all of our properties throughout the country, which is a major event, and basically only continued with sort of the immediate emergency type work, and essentially took a 90-day pause. And of course, we're a very good borrower, so we have a lot of banking contacts throughout the country, and it was clear to us that the banks were doing what they typically do, and which was being defensive and freezing. And so they froze relatively quickly, like how you would expect. And so we were preparing just to make sure we had cash. And now it's a little bit different. I feel differently now than I did in April. Obviously, we've still yet to get control of this thing, which is disappointing on a number of levels. And I do think it's having significant cultural, longer-term impacts on things that are hard to, it's going to be hard to revert back on a number of things. So I think there are shifts happening. I mean, clearly what you see in the New York City and the major city element is there's who would have thought this? There's an exit out of the major city into the suburbs. I'm touring a building today with our chairman and our head deal guy to buy a major corporate campus, not for our own use, but on a value add strategy, a major corporate campus in New Jersey. Because we think there's going to be a big push of companies looking to have satellite offices that would have not thought about that. So I think there's major things happening, but I mean, we've held up well, and now I think where we are now in the cycle, I think, is trying to figure out where the opportunities will be. Frankly, we're not really seeing them yet. We bought some debt, some distressed debt, like Bill indicated. I think that's sort of obviously an obvious play if you can find it. We did end up buying some, the REIT stocks got hammered. We ended up buying some preferred debt of some of the heavily discounted REIT plays. That was sort of an initial move because the stock market reacts so quickly, whereas real estate, we all know, is such a laggard. But I personally think there's a big tidal wave coming because to me, it's a question of how long can you hold out. Obviously, multifamily is very, very favored. So is industrial. But the question is, how patient will the banks be when you owe them money and when you have underperforming property? So that's really the question of the day. And frankly, I think patience will likely be a winner in the end.
Right. Which leads me to, you mentioned you're in New York, David. I know, Jim, you're there in Chicago. But all these uprisings we're seeing, like Black Lives Matter, police, defunding, these protests that are going on. What does that do to commercial real estate and their values? Jim?
Look, it's really disturbing to see the country in such political and societal unrest, no matter what the reason. And it's been very difficult for some of these cities, in particular, these larger cities with large budgets. And the combination of COVID and the political unrest has been really, really disturbing because what the ultimate cost is going to be. I was listening to Squawk Box this morning. The head of the MTA in New York was on TV saying we just got a $2 billion check from the federal government, but now we need another $3.5 billion to balance the budget on the MTA. And by the way, we've suspended all of our capital projects, which is what got them in trouble in the first place. And so all these major cities with major infrastructure and cultural activities and the reasons people move into the city, the question's not, and I don't want to talk about our firm that much, but we took a tactical position already about the shift of millennials, moving out of the city because they couldn't find good schools potentially, or there weren't enough good schools and they needed cheaper schooling and they needed more, green space or whatever. We took that tactical position a couple of years ago. So that's not necessarily a surprise. COVID has definitely accelerated that. But the real issue becomes, does the empty nester, does all the guys on this panel, do they decide to sell their home in the suburbs and move into the city? Are people are the people who have money, not the people that don't have money, but the people going to have money, are they going to move back into the city and kind of refill the coffers of some of these cities? So the answer is, to your question, I don't know what the outcome's going to be, Neil. I don't think anybody does. But we do know that we're kind of heading into a recession. Nobody really knows what the impact of that's going to be or how long that's going to be. I think the stock market's kind of avoided the question. It's kind of been amazing to watch the stock market as an investor and also as an observer. So I don't think there's any panacea for anything. I think the major cities will still prosper. I think the resilience of a New York City or a Los Angeles or a Chicago or a Washington or a Boston, these major markets, I think they will be very resilient. I think it will take a long time, though, for them to recover from some of this. It depends on, again, the political environment and whether, we've got, a society that wants to, Chicago, November, we have a progressive tax that they're trying to pass. What's that going to do to the people that have earned their, how many more people are going to emigrate from Chicago because of this tax, if this tax thing happens? The issues in California with immigration and some of the issues associated with the whole thing with the fires, that was evidently avoidable without the environmentalists getting. I don't want to make a social statement. It's just like there's things that big society wants that that not necessarily is best for everybody, and that's always going to be the case. So I don't really have a good answer for you.
Neil, one
Bill,
comment.
how do you see it?
Neil,
Go ahead.
one comment on the budget. When you look at a lot of these major cities, particularly, let's just say New York or Chicago, a lot of their revenue generation, even on the revenue side of the budget sheet, actually is a calculation of net operating income on a property, in the actual property. So what's happening is they're putting numbers in a budget as if they're a given. Meanwhile, the real estate person is going to be challenged in the taxes because the property's gone down in value and the NOI or the income is eroded. So I'm not even sure how that's cycling through yet, because I'm not even sure the revenues they think they have are collectible in a full capacity way.
You guys are investor, David, in Chicago. You know what's going on. I mean, there was a reassessment. We're in a triennial. There was a complete reassessment of commercial versus, there is every 3 years, there's a reassessment of real estate property taxes. We already have the highest property taxes per square foot in the country for commercial real estate. And they just whacked the property owners, the commercial property owners, because they realized they couldn't whack the residential real estate owners.
Well,
I don't know where that's going.
Well,
I don't know how that's going to fund. We have probably the best. Listen, I'm an ex-New Yorker. We have literally the best infrastructure in the country, planes, trains, and automobiles for a big city, and it works. I don't know what's going to happen if they don't maintain that stuff in major cities. I don't know what's going to happen. There's a whole concept here of us versus them that seems to be fluctuating in society today. I don't.
Yeah, Bill, what were you going to say there?
Well, I was going to say, we've got a big issue on the ballot for California, which is split roll tax, which is we've had our Prop 13 protection, which is locked, it's locked your values to purchase price plus 2% per annum. And they're now trying to separate out office and retail properties. They've left multifamily because that impacts renters. So they've left them out of this round. But the ultimate target is, in my opinion, is for the unions to ultimately get more money to the state, which comes back to them. And, and ultimately they're going to go for multifamily, and then they're going to go for the single family. And so it's going to hit everybody. But I got to tell you that I think if that passes, I think you're going to see businesses leave California, because look, it's either hitting the property owner or it hits the tenant. And in most cases it's hitting the tenant initially, because you got a triple net lease that's passing through to the user. Well, how do you manage your business when the state decides to change your taxes and all of a sudden you get this horrific tax increase? And particularly here, where you've got a lot of property owners in California where they're corporately owned. For example, the building I'm in, the Irvine company owns more real estate than any private company in the world. And so the building I'm in today was built in the 80s. It's never traded hands. It's never going to trade hands. So it's on a zero land basis. And the cost of construction from 1982 escalated at 2% per annum. So but I based my floor rent based on whatever my pass-throughs were. If these guys get a big property tax jump and now my rent jumps dramatically, what do I do? Well, in my case now I'm looking and saying, look, nobody's in my office anyway. Why don't we just go virtual? Why don't I go hire people in Kansas and Texas who can do my job. You know, my accounting team, and David, you said your folks have come in. My people aren't coming in. They're doing accounting remotely because we're all web-based and we're all electronic on our AP system. We have very little paper in accounting. I'm a paper guy. You can see my office has got lots of filing cabinets. I like paper, but my team doesn't. And I'm like, I've looked at it and it's great. I'm glad you guys can do your work from home, but if you do your work from home, why would I replace you with a California salary when I can replace you with a Midwest salary? So I think there's a lot of things left to play out that are going to be really interesting, and I think the states have really got to pay attention and be mindful of their budgets. I agree we can't not give them any money, but we don't need to expand their budgets right now, and that's what California's trying to do. Split roll was on the agenda before COVID. This is just a money grab to be able to create more revenue for the state. And if you look at our budgets, we're growing at about 3 times the rate of inflation for the last 10 years for the state of California budget. That doesn't work because it used to be that a public employee made less than a private sector employee, so then they got this fat pension to make up for it. But that's not the case anymore. The average California public employee makes more than the average private sector employee who gets no retirement account, and the California person gets a huge retirement. So that imbalance is going to have to be solved here. That's actually, in my mind, the number one problem for California. And I love California. I'm the guy who left the no-tax state of Texas and moved here. So I love the opportunity it's presented me, but I'm very concerned about it right now. So, sorry.
Which leads me to the next question, which is, go ahead.
I just want to comment because both David and Jim, thematically, we've thought about this. In fact, I made some notes that encapsulating what I think they're communicating is this whole north-south, even west-east migration, right? That was pre-COVID, and it's certainly something that's going to be a very realistic trend that I think is going to sustain itself, if not accelerate. Part of that was just addressed, basically the taxation issue, but also the demographics. People that can migrate, that don't have children, school-age children, that are more late in their careers or near retirement in their careers, they have the option of migrating much differently than somebody who's mid-career and has a family. So I think the north-south migration patterns, the west-east migration patterns, I'm very concerned about the whole impact on businesses. You can't just keep going after the same, the pockets aren't that deep, and before you know it, there's a hole in your pocket and they're leaving. So the density issue of going from a more dense urban area to a less dense suburban area are trends that we're looking at, and I think all of us can agree that as concerning as these political maneuvers are to try to fill in revenues for unrealistic social entitlements and promises, I think there is a reality point, and even California, I think I'm more optimistic that at some point they'll begin to realize we have to manage the whole fiscal burden differently than because of COVID-19 and moving forward.
Well, I think you're right on that, Bernie. That hopefully people will wake up at some point when they see people leave. But I mean, when I have friends of mine who built their businesses here in California, and they've left, and even though they still have a substantial amount of their business here in California, when people can leave and they get massive savings.
Yes.
And I'm talking about massive. So I have one friend of mine who runs a very robust business, and he still has a lot of business in California. He's still paying a lot of California income tax, but he saves, now the number I think has gone up, but when he made the decision about 2 years ago to move to Nevada, he saved $70,000 a day.
Wow.
Now we're talking about a very wealthy person, but at $70,000 a day, you can do a lot for society because you've got to believe you can make a better decision about where that capital goes than government. And he can become more generous with his charities, and at a very big number, and he is, thankfully.
So where's the opportunity, guys? I mean,
Yeah, that was the next question, Jim. That's actually the question. So what region do you see the opportunities, and do you see somewhat of a demographic shift? So Jim, take it away from there.
Listen, one more comment. The other thing nobody's thinking about is, institutionally, I've heard this from institutional investors that we talk to from time to time. There's a problem too. Also, nobody's talked about the environmental impact. I mean, California, the flooding, global warming. Nobody's talked about places like Miami, New York City. I don't know if Los Angeles is necessary, but basically people thinking that in the next 20 years, the amount of water table that's going to rise is going to severely impact these cities. And like New Orleans is a disaster waiting to happen. I mean, frankly,
Yeah.
That's a whole nother conversation, but just, that the impact of the water table globally rising is gonna impact these cities. Institutional investors are looking away from the major, real estate markets because of that. Or real estate developers or real estate owners are taking defensive measures to make sure that if something like that does occur, like the hurricanes or whatever, that they're building to a different building standard. But Neil, to talk about opportunities, my view of the world, from talking to a whole bunch of people and being on these panels and doing a lot of listening, is right now, I think it's kind of too early to see for my world. It's kind of too early to see specific opportunities as yet. I think there's obviously stress in retail. There's obviously stress. There may be some stress in multifamily, believe it or not, because we had such a prevalence of really preferred equity and mezzanine debt. So people used to leverage real estate to 70, 75% with the agencies in multifamily, where now they can leverage to 90%, with private capital. Same thing with some of these debt funds, office buildings, people borrowed, north of 65% leverage up to 80% leverage. There may be stress on particular assets or particular asset classes because we had so much abundance of debt capital in the marketplace a few years ago. But it's kind of too early to tell. The flow through from the banks, we haven't seen that. CMBS, believe it or not, there's CLO CMBS activity going on today, but with specific assets. That's kind of starting to occur again, but again at wider spreads. So there's things going on right now. We haven't seen the trickle down effect yet in my world. Maybe somebody else can comment. Certainly hospitality, as what Bill said about, you got to pay the piper. Maybe next year you're going to pay the piper at some point. There's been a bunch of rent deferments. I don't know how in New York City, for example, David, I don't know how the governor can come on the TV and go, look, just don't pay your rent to the end of August. But by the way, landlords will get back to you. We don't have a plan for you yet, but just don't, residents in New York don't pay rent. They don't pay rent. So I don't understand. I don't get it,
I don't get that. That's why we didn't buy in New York. We looked at a massive portfolio, and then, the rent control rules came out, and then other things. But, two things there, Jim. One, the other trade we're looking at opportunistically is we are buying retail, but with the idea of rezoning, re-entitling, and demoing for the land. We're really buying for the land value, and we're buying it for residential for sale and for rent values. For sale is easier for us because we think we've got a good handle on that. It's a little tough for me to figure out what multifamily land should trade at, not what I thought it should trade at, in February. So that's kind of squeezed that margin a little bit, but we think that's a trade that makes some sense. I still think if I can produce for sale housing land in California for the public builders to build it kind of FHA price points, I think that's a trade that still works here for a while because we're so undersupplied. The other thing I just wanted to quickly say to you, Jim, is that sea level rise, it's already reality. So we own a couple of coastal sites, and we've been involved in this for some time. In California, you have to analyze sea level rise 2100 to build a project today. And so I have to actually raise my sites so that they would be dry in 2100, assuming kind of the midpoint global warming. So
one thing I didn't talk about, and we haven't talked because everybody talks about this too much, op zones. I mean, we're building workforce housing in Washington, D.C. right now. And we're doing that because, and what I've heard about with op zones is, people have taken a little bit of a different view, which is basically, the marginal deals won't get done and the better deals will get done. But what's really happening is people are taking a longer term view and saying, look, I'm just going to put this money away for 10 years and not worry about the next 2 or 3 years. That's the only thing I wanted to raise with you guys is people are taking, some investors, smart investors are taking a longer view of the world. And if they can put money to work now and leave it to work and not necessarily worry, you know, it's still a hard thing to do in real estate today.
So,
David, let's get back to you, David. So what regions do you see the opportunities in? Any of those regions include international?
Well, some definitely include international. You know, Europe, it's not a secret. Europe's done a significantly better job than we have in managing this event. So we're, you know, again, we like cheap, right? So the distress is really not here yet, in my view. So we're sort of just doing what we do. There's certain regions, we're investing in the Netherlands right now. We're buying a deal in Scotland. We're in Germany. We're in Italy. So there are opportunities in those places. The cost of debt, I know Bill indicated, you know, essentially it becomes, well, what your, you know, debt becomes a significant factor. So we've done well with buying cheaper office buildings in those markets and then being able to finance them very cheaply and frankly find tenants and lease up where there's activity. And then I would say in the US, it's really trying to find vacancy holes where you can basically buy income stream for a certain portion and then basically essentially get the vacancy for free. And the larger the vacancy that you get for free, the better if you actually think you can get leasing velocity on it. So those are the kinds of deals we're looking at. But again, from a debt standpoint, you know, I think there's going to be a wave of debt deals where you're going to be able to buy, you know, again, it really comes down to basis. What's your entry on the deal? And whether it's retail, whether it's office, whatever it might be, it's a question of where you're entering. And so we've always been very price focused. So there are different parts of the country that provide different opportunities. You could make an argument right now in the Midwest that industrial growth in the Midwest is going to continue to move because there's a sort of this sort of national movement pulling back from China and Asia, and that we should be manufacturing stuff here or more things here. And so you could see sort of a made in USA type event. Of course, to do that, you need space. Some of the space could be reutilized space from large vacant retail that's underutilized. So it's trying to look at space and trying to sort of evaluate what other uses there might be for vacancy and how to sort of reimagine it. And I think that's where there's going to be a lot of opportunity. And there could be areas, obviously, in Bernie's world down south, in the Southeast and South, they're encouraging people to come and they're very tax friendly and they're telling you that we want you and you're getting a different feeling from the Northeast. I as someone who's a lifelong New Jersey, New York person, I fear right now for New York, New Jersey. It's going to go through a very, very big shift. And the question is how loyal the people that are here.
Well, also taking away the Tax Act in 17 took away your property tax deductions in these high cost cities like, you know, New York, New Jersey, Connecticut. I mean, these states where you can't deduct your mortgage or your taxes anymore. So the home prices got depressed as a result. And
yeah, I mean, right now, you know,
you'll get those back next year.
Yeah, right now you're seeing this.
Probably.
Right now,
you get them back, you'll just lose your capital gains and your 1031 right.
That's the, you know, that's the other thing is that I don't, it's not so much, it's short-sighted in my view to think about the 1031 thing as a landlord only benefit. The reality is it creates transactions. So if ultimately they shut down 1031s, what it really means is all the lawyers, the accountants, the title people, all the various service people and all of these various transactions are going to have less business. And so I think you'll find that a lot of people will just not sell. And so you'll have a relatively stagnant market. And that's a concern at the economic level. And so
basically it takes the market to the pension client who's not tax sensitive, because the rest of us are going to be very thoughtful about what we'll trade or not trade or mean sell. Because if there's a tax impact that you weren't counting on. Yeah, you know, in my world, a lot of what we do, we buy, fix, and sell, and we're already bearing our tax. But that also means there's not a guy to sell to me. So I think that they end up they've only analyzed one part of the equation, which is we get the money, we get the money from the guy who's selling, but they forget all of that. all the friction in those transactions that they're going to lose.
Think
And
about
I think
transfer costs and mortgage recording costs.
right,
Yeah.
and the brokerage fees and the title people, all those people who pay ordinary income on that money, and I will tell you that it's going to be a net revenue loser for the government. I mean, a study was done on it when they were talking about it a few years ago, and it's clearly a net revenue loser. But don't expect that DC will be smart enough to read a study by a Big Four accounting firm.
No, or a Frederick Haig who said that capital doesn't pay taxes. People and consumers pay taxes. I'm framing it that way, but it's all passed on, and if you can't pass it on, you create friction in the system. Neil, these two gentlemen, Jim, and even Mr. Becker just mentioned opportunities. We're sort of fortunate in that we hadn't really started any projects that we have on the books at the beginning of this year, but we are moving ahead. We have a very high-end retirement community in Naples, Florida, that's going to be developed. It's a stable community. It's been around 40 years. We have a financing stack with local lenders that were negotiated prior to the beginning of the year, and they're in place. I think it was Jim that mentioned workforce and opportunity zone. We will be breaking ground on workforce housing in Dania Beach, just north of Fort Lauderdale. Puerto Rico, we partner with a hedge fund that acquired a distressed property in the last crisis, actually in 2008, 2009. And we have secured the development rights for that project. So we're looking there alone at well over a decade ahead of us of project development in one massive opportunity zone. And the other thing I'd like to point is we're in discussions with national wellness and medical companies that are looking at the building we're going to build here, which is going to have 60,000 square feet of wellness and medical. And also when it comes to Puerto Rico, hospitality, the Puerto Rico is still the most significant Caribbean-based vacation spot in the US. There's no other. Everything else is the Bahamas. When you think of Caribbean-based tourism, you don't think, to a lesser extent, you don't think Puerto Rico, you think the Bahamas, Jamaica, et cetera, but Puerto Rico is tremendously attractive, and you don't need a passport. So where we're going is in those directions: workforce housing, hospitality, and other kinds of amenities in that opportunity zone, as well as the demographic.
I think we just lost Bernie's.
Yeah, something happened there. But that leads me into another question, right? So you would think that this would be the perfect storm for opportunity zone, right? I mean, opportunity zone gives you the opportunity to defer taxes on a capital gain. Prices are ridiculously cheap in a lot of asset classes.
And construction costs are down.
Yeah, I would think opportunity zones, obviously there's some changes that are coming, right? That by the end of the year, you have to invest in these things and such, and it's a 10-year hold. But I know that you have, Jim, an opportunity zone. So I'll start with you, but anybody else see these opportunity zones being something to stay? Is it worthwhile? I mean, there was a lot of talk about opportunity zones, 6 or 8 months ago. I haven't heard much about them now. But let's talk about it. James, start off, since you already have one in the market, and then David and Bill, but what do you see about opportunity zones? Are they real, or are they just something that's, like I said, a talking point?
There are definitely workarounds with some of the stress. Basically you have a cap. What's great about opportunity zones, to dumb this down for everybody, because it is complicated, is that unlike a 1031, you can sell anything, a piece of art. It doesn't have to be anything associated with real estate. You sell like a stock, a piece of art, a car, it doesn't matter. You generate a capital gain. You can either take all or some of that capital gain and put it in an opportunity zone investment. It works well with real estate. It doesn't have to be real estate. It can be a business. It doesn't really matter. But you have certain tests along the way with the government to generate what Neil talked about, those tax benefits, which are 10 years or longer. You have certain tests along the way that you have to satisfy, and it works really, really well with real estate development or real estate redevelopment. So what happened was everybody talked about this. There's a natural psychological disconnect between developer and investor, because developers like to build and sell and move on. Typically, they don't like to necessarily hold. Not every developer, but a lot of developers, fee developers as an example. And part of the problem is you have somebody who has to hold a piece of real estate for 10 years versus somebody who has to hold a piece of real estate for, until it's built. So that kind of went around. And then there was this whole, because of the way the opportunity zones were created, believe it or not, there's one opportunity zone or two in Manhattan, believe it or not. And there's, people are building Ritz-Carlton on an opportunity zone, which is not exactly the whole theory behind impact investment or opportunity zone investment. But what happened was there's a bunch of deals that had marginal returns, and people were told that, forget about the marginal return. Let's go worry about what happens in 10 years. So that was one thing. You had kind of the developer, builder, owner, investor disconnect. And then you had a lot of information that nobody really understood, because frankly, the government started off in 17 telling you about this. They really didn't end telling you about all of it till 19. And there were people that were investing ahead of the government finalizing their regulations. But, in theory, you knew 95% of what you needed to know, and you kind of knew it was going the other way. And then you had this whole time clock thing about, you needed to get the money invested within 6 months of generating the return. So all this information got thrown into a pot. People kind of figured it out. And to answer your question, I do think in the future, I think that there are good real estate returns that could be generated in specific opportunity zone deals. But here's my advice. My advice is you need a real estate professional, somebody who understands real estate, and then you need somebody who understands development if it's a development real estate deal, which means you need to be investing with people that have a track record and know what they're doing. In my particular situation, as an example, I've been in the real estate business 30 years. The joke is I successfully avoided development for 30 years. We've bought empty buildings. We've done redevelopment, all this other stuff. We've never done ground up. And I have a friend of mine who's 25 years developer. I trust him with my children. We're developing, we're building in a 26 acre PUD that's 18, 19 acres already built out with magnet schools and community center and, for sale housing and townhome. We're doing this thing in an area where we're really making an impact. Like where there's a definite need for housing. And that's a feel-good impact thing as well as so I think those kind of transactions where there's a definite contribution to society, it's not just and it's a good real estate deal. I think those will be good. I think those will work out really well. And again, long-term view, people putting money into an investment where they don't have to worry over the next 2 or 3 years whether or not it's going to make money. You can take a long-term view to COVID and think we're going to get through this at some point.
Yeah. David, what do you think? And do you think that the opportunity zone could be a replacement for the 1031 if it goes away?
It's really different. To be honest, my view is that the 1030, if you're coming out of real estate personally, I think a 1031 gives you much more flexibility. The opportunity zone really for me is someone who's selling a private equity position, a stock position. They had a business for X number of years. And really what I saw the government doing was essentially trying to encourage developers to go into areas that they regarded based on census data, which by the way was 10 years ago. So that, where they basically tried to encourage people to spend money in areas that needed it, and essentially gave the private equity, the stock player, that person who was selling a business, not real estate, the opportunity to then defer those taxes and own real estate long term. And so for that scenario, I think it works as part of your portfolio. And to the extent that you think you're building something that you think could go up in value in the next 10 years, meaning, you can make an argument about certain areas in New York or Chicago or LA or wherever they are. So I think there are opportunities. We try not to buy a deal or develop a deal, particularly when it's development, based on a tax dynamic. So we try and the way that we would look at it is we have to be willing to do it regardless of the tax benefits. And then the tax benefits to us is really just lower cost financing. Essentially, it's lower cost equity and or debt, however it's structured. So that's really how we look at it. So we're not racing to the opportunity fund world. If one came to us and we've looked at a couple, we'd be evaluating it obviously on a deal by deal basis. So I think there are plenty of good deals to be had, as Jim indicated. It's not, but you really got to be with the right people and you really got to understand it. And there's still, a little bit of cloud, in my opinion, over the whole opportunity dynamic.
Yeah, Bill, what do you think?
Well, we are doing one. So the land that we acquired in Las Vegas on the Strip is, I'm Jim. I'm one of those guys that got lucky, and I got a parcel on the south end of the Strip on South Las Vegas Boulevard that's in a QOZ. But candidly, it was useful to us, but we wouldn't have done it just because it's a QOZ. It certainly made for a more creative capital stack for us. But the deal has to work. I mean, I think you can't have the tax law doesn't solve for a 10-year investment. The deal's got to stand on its own, and then it gets better because your capital gets a little cheaper, and maybe in Jim's case, you're doing something that's a good thing. I'm not sure that other than I'm creating a lot of jobs, I'm not sure that there's great public benefit to building another hotel casino on the on the Las Vegas Strip, and we had to figure out a solution to how to do gaming within a QOZ, and we went through that machination because you basically got to condo the building and have an A/B partnership to do it, where you're buying a unit of both, and one's in the QOZ and one's taxable. The question, Neil, is it the replacement for 1031? For most people, it's not, because most people who've owned real estate for a long time have got mortgage over basis. So they've got to go bring outside cash to solve that gain problem from a real estate sale, because they've depreciated down that building over the years. And I'm not saying everybody, but certainly the great majority. The great majority of my clients who I run into doing exchange, they got a basis below their mortgage today. And so if they were to just say, let's just take the cash, they still got a tax problem. They got to go sell something else and solve that, and then they're just chasing their tail on this thing. So I don't think it's a simple solution for 1031, but I think there'll be plenty of QOZ deals done. And the fortunate thing is, this had bipartisan support. Both sides of the aisle liked this policy. They may tweak it, but I don't see the QOZ business going away, as part of the tax law changes that are almost certain to be upon us in 2021. So
let's make this like the last question, then I'll go to the questions from the audience. But so give me your one best idea. Where is it? What is it? And why? So David, let's hear from you first.
If you can find it, distressed debt at a significant discount.
Now, is this something that Time Equities offers? Is it a particular offering? Is it something that you just see as conceptual?
Well, we have a fund. We basically lump things together in a diversified way. But if you're just asking for an investment idea, to me right now, the basis, the sensitivity around basis, the entry point, and trying to take advantage of some significant discount, likely will give you the best basis going in. And to me, that's sort of, if I had one idea, I have a lot of ideas. I'm happy to share them all. But if you ask me what my instinctive best one is, it's distressed debt at this discount.
All right. Jim?
Give me 1 second, please. I'm sorry. I'm just answering one of the questions here. I think that, the stress, I think it's going to go city by city, asset by asset about opportunities in the future. And then the debt, everybody wants to play the debt game. There's massive amounts of, I think there's money being raised by funds who think that they're going to play in the distressed debt game. It's really unclear what the banks, the banks are much better capitalized today than they were years ago. It's going to be a question of what the banks are prepared to do. We know that kicking the can down the road is probably not going to be an option that dramatically unless the government puts a lot of pressure on them. And the banks have better, resources to clear the market with bad loans. And we'll see. I mean, I don't know. Again, we could get a V-shaped recovery. We don't really know. Some people have lost money in their businesses and they made money in the stock market. It just depends on how society's going to handle the higher levels of unemployment and how society's going to handle some of the social needs that are going to occur and how we can, kind of get along with each other in the future. So it appears it's always distressed debt. Every economic cycle I've been through 3, it's always distressed debt everybody's looking for. And there will be trades and there will be opportunities and there will be great opportunities, but it's unclear right now when that's going to occur.
All right. Bernie, we lost you there from a lightning strike in Miami, but
I don't know if anybody saw that picture of the Statue of Liberty getting hit with lightning yesterday. Well, I think that same cloud came over our spot right now. So I'm back, but it was a big one.
So Bernie, where do you see the opportunity at this point? One opportunity, or what you think is?
So conceptually, it's really, there's a lot of international money continuing to flow into the U.S. So what I would say optimistically is it's about remaining optimistic. We've been through cycles before. We've been through challenges economically before. I like to look at the glass as half full. And then you look at Miami and the South Florida market. And Miami is New York South and Latin America North. Demographically and many other reasons, I think there's opportunities in this market, like all real estate markets within markets. So I'd have to say we could very much try to be optimistic, Neil, without getting into specific projects.
Bill, anything?
Well, clearly, if you can find it, distressed debt, we just haven't found it. We like our retail to office trade, and then I'm working on some funky deals. I'm buying a landfill right now in North Dakota. You know, it's a business trade, but there's an opportunity to grow it and utilize in that case really cheap debt, because we can finance it with tax exempt bonds. So right now with spreads where they are, that's kind of an interesting trade, but it's an obtuse trade to our business. It's not our core business, but it's an opportunity to buy something where we think there's dislocation in the market today. So
Right. So in the interest of time, I know we're at an hour. You have time for questions, panelists, or should we just email these out and you can reply? What do you think?
I'm working remotely, so I'm good.
All right. Okay, go. Let's go with them. So question here is, how will suburban Metro New York area shopping centers evolve due to COVID, where you see massive vacancies and probably tenant rent reduction requests?
I
Take a
that.
stab, whoever wants to do that.
Well, I guess just because I'm here. They really haven't let the regular, other than restaurants, and even restaurants, so I have many friends who have restaurants, they really haven't let the tenants operate. So the question really is, how long can, who can hold out and how long? And then in that given circumstance, how flexible is their landlord? And then how flexible is the landlord's lender? So you have all these different parties with different objectives, with different stakes in the game. And the question is, will they all be able to work together to get to the other side? And the longer it takes, the more concerned I would be about their businesses longer term. And to the extent that we can drive this thing home and get through it, then I think, they have a better chance. But I think fundamentally, as an example, if you weren't an online shopper prior to this event, you are now. And so I don't know what that does to the typical retailer. I think a lot of restaurants have tried to figure out how to do stuff outside, how to get their delivery business going. But to me, there's going to be less tenants. Less tenants means less retail demand, which means lower rents. That's what I see in the short term.
David, this one's actually directed to you, and they are asking, how do you see the Italian debt paper performing?
So we bought an NPL, non-performing loan pool in Italy, I guess a year and a half ago. And we bought it at 25 cents on the dollar. So it was a significant discount, but it was pre-COVID. And then, of course, Italy, as we all know, was fully under attack with Corona. We're working through it. You'd think a 75% discount to a loan paper would be a substantial amount. I think in the end it'll be fine. It just needs time. But I think right now that whole country is in shock and they're sort of working their way out of it. So it's been hard to really make deals with borrowers or do anything in terms of relief. But so I would say it's in a holding port. But hopefully our discount was steep enough to even weather this. We'll find out.
Right. And Bill, I'm not sure if you answered this already, but there's a question regarding the California building fees. Are they excessive and are they prohibitive? I'm not sure if you typed the answer, but in any event, how do you reply to that?
Well, I mean, because that's one of the solutions to the state of California was that they put the onus back on the cities, and our fees are very high. And basically, I look at it as the cities become the partner with the underlying landowner. But for the developer and the builder, it's just factored into a cost, just like, sticks and bricks. So it hurts the underlying landowner. But for me, when I buy a site, as long as I can accurately predict them, it's part of it. But I think where it's excessive is it ultimately hurts the homeowner. If I'm building a house and that house has $50,000 of fees in it, I've just passed it on as a cost.
Or you don't build the house.
Or I don't build the house.
Yeah.
So you got two problems, which is we're not building enough houses. And right now the fees are higher in, say, Riverside or San Bernardino than they are in the coastal markets, because those people are more pressured for generating revenues. And so as a percentage of the sales price, it's a much higher percentage. You know, a $400,000 house in Lake Elsinore has $55,000, $60,000 worth of fees, whereas I just did a deal in Anaheim with $35,000 worth of fees. That's a $700,000 house. So, you know, I think it's problematic. I think the problem is that the way we've designed our system here, it's we don't want anybody else to build. We want them to pay all the cost of everything, including like that me as a builder should build an affordable housing unit, but I don't create that need for an affordable housing unit. If anybody should pay the affordable housing cost, it should be the employers who don't pay adequate salaries. I'll pick on one, Walmart, who doesn't pay adequate salaries and doesn't pay adequate health care, and they should be paying that cost. They've created that problem, not me as a, I'm solving a problem as a builder developer. So I find it to be offensive that how the solutions come down. You know, I've factored into my business and it works okay, but ultimately the consumer's paying that. If I go do affordable housing in a project, that doesn't come out of me. It came out of all the other tenants who aren't subsidized, or all the other home buyers who aren't subsidized. And that's the part people don't get, is I'm just putting the burden on somebody else's shoulder. And now I think you're finally seeing people here in California get the problem. And the problem is their kids can't live here. My kids can't afford to, my kids who come from a family of means can't afford to stay in California and own a home.
Yeah.
So you know, look at this group of people. We're all wealthy people by any standards. And our children can't stay here. That's a problem. And so if you're maybe just, you know, slightly, you know, upper middle class, you got yourself through and you got your kids through college and they don't have a bunch of student loan debt, they still can't afford to stay. And so like I'll use my brother as an example. My brother's lived in California his whole business career, 50+ year trial lawyer in San Francisco. He's going to give his son and daughter-in-law their house. And then to make that even, he's going to give his other daughter the equivalent amount of equity so she can go buy a house. So we're talking about millions of dollars of wealth transfer. They're fortunate they have it. But that's what it's going to take to keep his grandchild close to him.
Yeah, it's crazy.
That's a messed up deal. So
yeah, it's very messed up. So another question here for you, Jim, regarding qualified opportunity zones. It's talking about most of the capital outlays in the first three years, and then the project's expected to last for 10 years. How does that work?
Well, what really is happening is if you're building something, you're obviously building it over the next couple, 20 months, 24 months, 12 months, whatever. So you're building a project. I think what the question may relate to the fact that you have to create a certain level of value in the property in order to qualify as an opportunity zone investment. And that's why development works for an opportunity zone. If it's a business, you have to effectively, create a 30% increase in value. I forget what the number is. I think it's 30%. It's, you've got to basically start a business and show the government that you've created, additional value in that business by that. With real estate, it's really easy. You spend $1, now the thing's worth $1 more. So that's why, development's kind of a good thing for an opportunity zone. And I think that's what the question relates to, Neil, because I mean, at the end of the day, we don't want to be spending any more money. We want to build the building, you want to stabilize it, and then you want to enjoy the cash flow and the appreciation on the property within a certain limited period of time. And what we didn't talk about is, in an opportunity zone, you can also refinance that property and take capital, take some of your invested capital off the table. And obviously that's a cash flow related event, but you have the ability to do that. Not all of it, but a lot of it. So in theory, if you build something for $1, you borrow $1, you build it for $1, now it's $2, you build it, you stabilize, now we're $3, you can effectively take the $2 off the table that you used originally and have $1 left of equity value.
Yeah, and hopefully you're pulling out at least enough to pay the tax that's due down the road.
The capital gains that you don't necessarily, you defer, you don't
Right.
avoid. You do have to pay
Right.
them. You
That's
pay a majority of them if you've done this correctly, not all of them, but a majority, 90% of them or 85% of them. Yeah.
David, this question's for you. In New York, everyone's talking about work from home. Everyone's talking about Zoom meetings. Don't go to your office. We're giving up office space. Companies like WeWork, obviously, they're probably going to hurt. But what do you do if you own an office in New York?
Well, office in New York, listen, office in New York, typically what happens in New York is you have good tenants. And so the question is, what term do you have on any buildings you have and whatnot? But I think the bigger issue is, where will the talent want to work for various companies, right? So if you think about a company, what you really have to think about is your workforce, your tenant base. I think New York's going to go through a bumpy ride. There's no question. Whether it's long-term or not, I can't tell you. I don't think that it is. I think New York always comes back. It's such a resilient place, like the other major cities in the United States. But New York has always seemed to sort of find a way. Here you have sort of the perfect storm lining up, though. It's the coronavirus, which is obviously what triggered it. So I was walking around in our office area the other day in Union Square, right on Fifth Avenue. You have a combination of dark stores because they're not open. You have less people based on the office environment because everyone's staging people in at the moment, or either told people to work remotely. So that's obviously hurting local retailers and from an office point of view. So you have tenants that are trying to make decisions right now, and it's hard to make decisions on current data because we're in just such a wild period. Clearly what's happened is there's a whole group of people out there that have opted to work remotely now, even when they're allowed back into the office. And so the question is, if you're a talented producer of one of these firms, whatever it is you do, are you going to be able to dictate to your employer going forward? If you are, that's going to take a whole group of people out of the city that will be working sort of on their own clock. That won't be good for office. There's no question. Again, less tenants, less demand, lower rents, lower value. And
taxes.
And one additional thing, which is New York specific, is we've basically told other countries that we don't want you here. So what's happened is, whereas New York was, let's say, the #1 favored place to invest from abroad investors, now you have this gap where if you're actually trying to sell an asset, the question is who's going to buy it. And there will always be, I think, a pent-up demand for New York office. I do believe that. But you've taken a lot of the buyers out of the equation, at least temporarily, and then you have people that actually can't get here.
Right.
So from a capital market standpoint right now, I think it's going to go through a bumpy spot. But look, the one thing about New York office owners typically is they're typically well capitalized. It is a lot of the large institutions. They have endless amounts of cash. It does seem that
families, yeah,
or large families that have a basis at whatever, and they can stomach these waves. And so I think office will go through a bumpy period, but I think it'll survive in the end. They do. And
I second that.
I would hope.
And I also think that people are going to go with it. It doesn't matter. People are going to go with, it's like you go where the money, like P.T. Barnum says, you go where the money, you go where the jobs are. So wherever the jobs are, people are going to go. And young people are going to go no matter what. And by the way, the young person wants to be in the office and be seen in the office so they can get promoted. The middle manager needs to be mentored. They're going to end up in an office at some point, maybe not 5 days a week. And the senior person, everybody on this call has an iPhone or an iPad and a laptop, and they're mobile already. They're already doing what they've been doing for years. So there's a whole theory about this, but I go back to, go to where the jobs are, wherever the jobs are going to be. And these big companies, by the way, it's a liability issue. It's not necessarily it may not be a health issue. It's a health issue right now, but it's more of a liability issue because companies based in major markets may have a national policy of stay out of the office right now. And it may not matter in Des Moines, and it may not matter in, Evanston, Illinois, and it may not matter in, South Dakota if you're in the office or not. But it matters in New York, Chicago, LA, if you're in the office or not. And that company, so I'm not taking any chances to get sued. There's no national healthcare policy. There's no OSHA regulations at this point. There's nothing that tells us what to do as employers. That's a very scary place to be right now. So everybody's being cautious and everybody's being conservative, which they should be.
I
All right,
agree with
Bernie.
that. Hey, Neil, I've got to jump, but appreciate you guys
Yeah.
letting me join. So thanks.
Absolutely. And I wanted to thank everybody, Bill, David, Jim, Bernie, thank you very much. Thank you for everybody who's listening in. Again, maybe we do this version 2 down the road here. So great group, and everybody, thank you for taking the time. It's already an hour and 15 minutes. So some of us have to get back to work. So in any
Yeah,
event,
thanks,
thank
guys.
you, everybody, and have a great day, and we'll talk to you all soon.
Thank you.